Hi everyone, welcome to our new lesson. This is about income statement, and if you see in the bracket it's trading account. Actually income statement is a combination of two accounts. One is the trading account about which this lesson is all. So we'll finish the first section of the income statement called trading account here, and then we'll move on to the next section of the income statement next week. So if you see the syllabus units, they are 2.7 to 2.9, and there is a part of the fourth unit, and even there is a part of the fifth unit also, but we'll do it as we gradually move on. For this lesson, only textbook pages 38 to 42 are the relevant pages. So let's move on to the next slide. Here you can see the first bullet point. It tells you about the income statement. So it's a financial statement which can be done at the end of a financial period. Normally we do it end of the financial period, but you have a choice to do it more frequently. The period is your choice. It can be done as frequently as you would like. You can do it monthly, quarterly, or semi-annually. But the idea is that it shows you the profit or loss. So let's circle the word profit or loss. So this is the whole purpose of preparing the income statement. So it shows the profit or loss. So having circled it, let's highlight it also so that it pops out at you. So the profit or loss is the purpose of preparing the income statement. The concept of profit or loss is actually when you have a business, you earn money by selling goods or providing services. So you have your earnings. So we see in the first bullet point, you got your earnings there. So you have got your earnings, and the earnings can come from different sources. Sale of goods, that's the major source of earnings, and then you can have some minor sources also, like rent received and discount received, etc. So all these earnings are added up, and then the second step is all your spendings, which are on your regular expenses, they are added up. So here don't mix the spending on non-current assets. That spending goes in the SOFP, you know that. So here the spending only the ongoing operations, like buying the goods and paying for all the regular expenses like salaries, wages, electricity and utilities and all the rest of it. So in first step you show your earnings, and in the second step you show your spendings, and then you minus the spendings from earnings, and you get your profit or loss. So if your earnings are greater than spending, it's profit, and if your spending is greater than earnings, then it's a loss. And in terms of double entry, once you have done all your incomes accounts and expenses accounts, you transfer them to the income statement. If you remember, we did it in the journal, and I told you that we'll explain more about it. So incomes and expenses accounts are uh, balanced, and the balances are then transferred to the income statement, and that eventually shows you the profit or loss for the period. So you can do your income statement, you can think of it as a T account, or you can do it in a vertical layout, as you will see in the coming slides. So let's move on. Here's the two sections of the income statement. The first section, which today's lesson is all about, it's called the trading account. So in the trading account, we show two things which are marked here as A and B. So let's circle A and B. So these are the two things that you need to prepare your trading account. So A is your revenue, that's your sales minus sales returns. Let's make some more notations on the side. This is also called your net sales. So you can just write here in the besides revenue, you can call it net sales, or you can call it turnover also. So it is called net sales or turnover. So the first step is to calculate your net sales, which is sales minus the sales returns. In the event there are no sales returns, then sales will be your revenue. So this is the earnings basically. So the revenue is the earning. This is what the business earned. The second step is to earn this revenue, you have to spend money on purchasing the goods, and bringing them to the saleable condition. So the cost of goods sold is the cost of bringing the goods in a saleable condition. So let's make a notation besides cost of goods sold. So it's the cost of bringing goods in a saleable condition. So this includes the purchase price of the goods and any shipping that you paid on buying the goods. And that is your cost of goods sold. So once you have, and it has a formula which you can see in the bracket, so you have to memorize this formula. So just highlight that formula, very important. So you must memorize it. It's the opening inventory plus the purchases minus the purchases returns plus the carriage inward. Carriage, we have not discussed much about it. For now, just remember that it's cost of shipping if it is paid by the buyer. So if you are buying goods and you're paying shipping yourself, then it's carriage inward and it will be included in the cost of goods sold. And then if you have taken any goods for your own use, you're going to minus it because they have not been sold, so they should not become part of cost of goods sold. And the closing inventory is also the goods which still have not been sold, so they will also be removed from this year's cost and included in the next year. So once you have calculated A and B, then just minus the B from A, which means cost of goods sold is subtracted from the revenue and you get your gross profit or loss. Gross profit, if it's a positive answer, that will be the case most of the time, and if you get a negative answer, then it's a loss. So that's it. The second bullet point we'll not discuss now. That will include with the next week's lesson, where we will show you the second section of the income statement. So again, a quick summary. The first section of the income statement is called a trading account. It shows two things: the revenue, which is sales minus sales returns, and the second thing is cost of goods sold, which has this long formula which I've just gone through with you. So you're going to memorize that formula, which is cost of goods sold, and it is also called cost of sales. So we can write that also beside it. So cost of goods sold can also be called as cost of sales. So it is the same thing. And once you have calculated cost of sales, you subtract it from the revenue, and if the answer is a positive number, it's gross profit, and if the answer is a negative number, it's a gross loss. So let's move on to the next slide. This is how a trading account looks like if you do it in a T account form. So on the credit side of this account, you're going to show your income. So can we write on the side, this is what the business earned. So that's the earnings. This is what the business earned by selling goods. So this is earnings of the business by selling goods. And why we are saying selling goods here? Because it's for a trading business. You will see the income statement of a service business later, that you don't have to do a trading account for a service business. So this account is only done if you are buying and selling goods. So for example, if you have a shop and you sell computers, so you will do your trading account first. But if you are just a service provider, say you have a taxi company, then you don't have to do a trading account. What you do, we'll see later. So trading account is only done by the businesses which buy and sell goods. So the credit side shows sales minus sales returns, which is the earnings of the business. Now out of those earnings, on the debit side, if you see the box there, that whole box, as you saw in the formula in the previous slide, that's your cost of goods sold. So that's the B in that formula. The credit side, what we showed was the A of the formula, the earnings, and the debit side is the B of the formula. So then you balance the account, and the balance is shown as gross profit. So actually this is the balance CD, so we can write beside it balance also. So this was actually the balance on the account. So this was balance CD, but here the balance is called as gross profit, and this gross profit is going to be transferred to the second section of the income statement, and we'll see when we do that lesson. So again, a quick summary: a trading account on the credit side shows the earnings, and on the debit side it shows the cost of goods sold, and then we get the balance. And if the balance is a credit balance, which means the credit side is bigger than the debit side, it's the gross profit. If it's other way around, if the debit side is bigger than the credit side, then it would have been a gross loss and it will be shown on the credit side, and then it will be shifted to the next section as the loss. Okay, so that does the one layout of the trading account. Another layout was shown on the next slide, which is the vertical layout, and this is the one which we will follow. In the exam, you will not be required to do it in a particular layout, so you can choose your layout, and what we will do as a class is the vertical statements. So we'll always do the trading account and the second section, which is the profit and loss account, and then the whole income statement also in a vertical statement layout. I've shown you the horizontal or the T account in the previous slide. That's just for seeing the double entry completed from the expenses and incomes accounts. For the purpose of actual preparation of the financial statements, we'll stick to this simpler layout. In this layout, you see there is no debit credit side. Like if you remember in statement of financial position, we did in vertical layout. So this is the income statement done in a vertical layout, having two columns, the inner and the outer. The inner column is for the workings or the calculations, and the outer column is for the answers. So the first step, we can box them again, the sales and sales returns. So that's your earning again. So we can write the earnings here. So that's the earnings of the business, earnings from the sale of goods. So just hold on for a second, we'll fill it up. So that's your earnings from sales. Okay. And it's obvious sales returns are deducted. So you see in the first column, the sales returns are shown in the bracket. So bracket means minus here, so we can just make a notation here that less, so you're gonna minus, so we'll just write less. So we subtract here, so less the sales returns. So sales, when you minus the sales returns, you get your net sales. So we can circle the X in the second column, and we write on the side a notation that that's your net sales. Take a second. So that's your net sales or your revenue. So this is your net sales or revenue. Then the next thing is, so let's make the complete notation. This is your net sales or your revenue. Okay, this is what the business earned. Then the second calculation is your cost of goods sold, and it's the second box in the formula, the B of the formula. And if you see in the first column, there are two numbers with the brackets, the purchases returns and the closing inventory. I think we missed something, so let's put the minus the brackets with the goods drawings also, because this is also to be subtracted. We missed that. So goods drawing is also a minus. Just bear with us for a second. So this is also a minus. So you see there are three minuses in this calculation. So you can highlight those three minuses. So just bear with us for a second. Okay, so those three highlighted numbers in the first column under the cost of goods sold, they are the minuses, and everything else is just being added. So we minus the purchases returns, and we minus the goods drawings, and we minus the closing inventory, and we get the answer and shift it to the next column. So we can circle that and write on the side cost of goods sold, which we have already written as a heading, but just write here again. So this is your cost of goods sold. And we will write with the net sales and A, so that you can relate it with the formula. So this was the A of the formula. Outside the box we can write an A. So this is the A of the formula, and this one is the B of the formula as we wrote in the formula. So that's your B. So this will be subtracted to get your gross profit or gross loss. So if A is a bigger number than B, it's a gross profit, otherwise it's a gross loss. So that's how you're going to do your trading account. So this shows you the results of your trading activity only. So this tells you how much you earned by selling goods and how much you spent on buying the goods. And if you notice, there is no fixed expenses deducted from the revenue yet, like electricity and repairs and maintenance, rent, insurance, salaries. They will all be shown in the next section, you know. So this is only for the goods, that how much you sold the goods for and how much it cost you to buy those goods which you sold. So we just so basically it's about selling price and buying price. So selling price minus buying price, that gives you your gross profit. But since there are details of that, that's why we have just put on those formulas, you know. So that does it. We can move on and we'll do some practice questions from your textbook. The first one is the question on page 162, practice question 1. It's just a calculation of the gross profit made by the retailer. So we'll just make the notations and we'll see what's the information given here. So we are given revenue. So let's say revenue. The revenue is $340,000. Just bear with us for a second. So revenue is $340,000. One more zero. And the rest of the information, let's put it quickly. We have purchases 200,000. And then it says that the retailer was not able to sell all the goods. It means he has some inventory. So there is unsold inventory. So closing inventory is there 20,000. So closing inventory is 20,000. And that's it. These are the three numbers there, and we have to find the gross profit. So first we would find the cost of goods sold. So let's do the cost of goods sold first, and then we can subtract it from the revenue to get the gross profit. So cost of goods sold would be the purchases, which is 200,000, minus the closing inventory, which is 20,000. So that'll be 180,000. And then we will minus it from the revenue. So your gross profit would be, let's write the formula for what gross profit is: revenue minus the cost of goods sold. And we'll just put the numbers now. So in the next line we'll put the numbers. Revenue is 340,000 minus the cost of goods sold, which is 180,000. So 340,000 minus the 180,000. So 160,000 is your gross profit. All right. So this is a simple one. So no need to put this equal sign. It's okay. That'll be fine. Okay, again, in the calculations, you don't have to write formulas. You don't have to write even these values which are given. You can directly, it's the first time we are doing it, so I've just put the labels also. So the revenue was 340,000, purchases 200,000, closing inventory 20,000. So we did the cost of goods sold first. If you notice, it's there are things which we discussed in the formula. They are not given, like some opening inventory is not there, goods drawings are not there, so you can just ignore them. So we found the cost of goods sold as 180, and then we subtract it from the revenue to get the gross profit. The question number 2 you can do yourself, so that's for you to do yourself. We'll go on to the next slide. There's question 4 on page 162 also. This has 2 parts in it. The first one is calculate the cost of sales. So part A is the cost of sales. And now we will directly calculate it. So cost of sales will be equal to the opening inventory, which is 80,000. So it's equals 80,000 plus the purchases 880,000, 880,000 and minus the closing inventory, which is 50,000. So let's make a calculation here. So it will be 80,000 plus the 880,000 minus the 50,000. So 910,000. So cost of goods sold is 910,000. That's part A. Part B is the gross profit. All right, and the gross profit would be the revenue, which is given in the question as 1.2 million. So minus the cost of goods sold from this revenue. So 1.2 million, we subtract the 910,000. So 290,000 is your gross profit. So that does the question number 4. And question 3, again, we can highlight for you to do yourself. It's the similar question that you can do yourself. And another practice question, question number 6 on page 163. Now this one here tells you to do the first part of the income statement. And the first part of the income statement, we can also mark here the trading account. So the first part is called, so with that in the bracket we can write a trading account. So you can just write trading account so that you remember that it's not a complete income statement, it's just one of the sections. And now we can just fill up the things which are given in the question. So we have revenue here, which is 945,600. That's your sales, and we minus from it the sales returns, which is 7,200. So we'll minus these two and we'll shift the answer in the next column. So let me check. 945,600 minus the 7,200. So that gives you 938,400. So that's your revenue. If you notice in the book, they have used the word revenue, but I have written the word sales. So we can write here revenue in the bracket also if you want. So revenue minus the sales returns. Basically sales minus sales returns is your revenue. Then the next thing is the cost of goods sold, which is the first thing, opening inventory. And in the question, opening inventory is 48,000. So we'll take opening inventory. Then purchases is 568,300. Alright, the purchases returns are 9,500. So this will go with a bracket because we're going to minus that. So 9,500. And then we have got the closing inventory, which is 39,000. The other two things are not given in the question, so we can just leave them. 3,900. So if you see, it's 3,900. I mean 39,000. So we 39,000, and if you notice the carriage inward and goods drawings are not there, so we can delete them. So we'll just delete them or cross them out because we don't need them here. This was a template, so these could have been there, so that's it. Now we will just solve the first column for cost of goods sold. It's 48,000 plus the 568,300 and minus the 9,500 and minus the 39,000, and that gives you 567,800. This will be with the brackets subtracted from the number above. So we're going to subtract from 938,400 this answer, and we get 370600. So that's your gross profit. We'll draw a line under the sales returns just to separate it. Then we'll draw a line under the cost of goods sold to separate it, and we can box them also just to show you. You don't have to do it. We just box the sales and sales returns. Sales and sales returns, will box them. Okay, that's your first calculation. Then we'll box the whole cost of goods sold. That's your second calculation, and then we can box in the outer column these two numbers which we subtracted. So this gives you the final answer, which is your gross profit. And we can line it also. So the gross profit we have found, and we can draw a double line under, or just a single line, just to show you that. So that's your gross profit. Alright, so that does question 6, and question 5 is for you to do on your own. And one more thing, the final thing, question 6 also wants you to do an inventory account in the nominal ledger. We'll discuss more of it in detail, but for now we'll just complete it as balance brought down. So the opening inventory will be the balance brought down on 1st of Jan, so 2018 Jan 1. So at the beginning of the year we had the opening inventory, so balance brought down, and in the bracket we can write opening inventory. So the opening inventory was 48,000, and this opening inventory has been transferred to the income statement. So on 31st December 2018 we will transfer it to the trading account. So we'll say December 31st, we'll say trading account. So this is a transfer entry, and mind you that this will be done in the journal first, the general journal. So what, 48,000, so 48,000 has been transferred to the income statement, and then they are telling us that there is a balance CD on the same date. So on the same date we have a balance CD, which is the closing inventory, which is 39,000, and this balance CD has also been shifted to trading account, and at the end of the year, so December 31st, this has also been shifted to the trading account, so 39,000, and then we would just add these two sides to show the total, which is 87,000 on both sides. And the next year the closing inventory will become the opening inventory, so we'll extend it for 2019. So 2019 Jan 1 balance PD, which is again the opening inventory for 2019. So write the opening inventory. That's the closing inventory of the last year, which is the balance CD, and it has been brought down as, and with the balance CD we can write closing inventory, so that you remember that this is your closing inventory. So that's your closing inventory. Alright, so this is how we complete the inventory account, and this account is only done at the end of the year. We don't keep this account while the goods are sold and bought, and this kind of inventory account is following basically an approach which is called periodic inventory. You don't have to know that for now. What you need to know for now is that an inventory account is needed in the nominal ledger only at the end of the year, where we started with the opening inventory, transfer it to the trading account, and then the closing inventory is shown as the balance CD, and that balance CD is also transferred to the trading account. Okay, and then the new year is started with the opening inventory, which is the closing inventory of the previous year. So that does it. Question 5 you can do yourself, and that finishes our lesson for now. So study well, and when we see you at the live session we'll practice more on that. So bye for now.